The TAP Alpha T2 series, TSYX and TDAX. These are brand new funds, 30% more exposure, weekly distributions, and amplified growth potential. Let's check these out.
Hey everyone, welcome back to the channel. I'm Doug the Retirement Guy, and today we're doing a deeper dive into two brand new funds from TAP Alpha, and that is their T2 Lift program. Now, if you haven't heard about these, I'm going to explain it to you. The two big funds that they have is TSPY and TDAQ. Now, both of these work. One works the S&P 500. The other one works with the NASDAQ 100. They have done so well with the zero DTE calls of those funds that they partnered up with another firm, and they are using 130% leverage. Okay, so they're using leverage, and they're going to the new funds will be paid weekly versus monthly. So they're getting into the weekly game plan with two very strong underlying assets and using leverage like other companies are using to generate more income and growth across the board. Let's dig deeper into those today. And if you're not a subscriber, hit that subscribe button, hit that bell notification. You don't want to miss any of our videos. We are just rocketing out there, and we appreciate everything that you do. Let's get into today's video.
Important investment disclaimer. This is for educational purpose only. This is not financial advice. Distribution risks. Distributions are not guaranteed. Yields are not guaranteed. They're always subject to change. So always be on top of your investments and always talk to a professional consultant before making any financial decisions. Same thing with tax purposes. So before we get deep into the new funds, we got to understand what is really the underlying asset that they're actually working with. And TAP Alpha has TSPY, this is the TAP Alpha S&P 500 Growth and Daily Income ETF, and the TDAQ, the TAP Alpha Intervention 100, which is actually the NASDAQ 100 Growth and Daily Income ETF. Now, these two funds we've covered before on the channel, and we've done some deep dives into them, and they're one of the top funds that are out there, because they use the writing call option that expires within 1 day, which is better known as zero DTE calls. So this allows for rapid response to economic data releases and provides a better upside potential than long-term contracts. Utilizing those zero DET calls allows the fund to avoid being locked into contracts during critical after-hour movements, providing a significant advantage over week-long or month-long strategies. By utilizing daily options, the fund is not locked into long-term contracts. And it's a unique approach aims to maximize time decay benefits while simultaneously reducing overall time risk. So the funds that they're doing now is TSYX, which is the TSPY lift, and then TDAX, which is TDAQ lift. So they're using the TSPY underlying fund. They're targeting exposure to get 130% of the daily performance of TSPY. How are they doing that? They're doing it with a leverage mechanism using total return swaps and daily rebalancing. And they're going to be paying out distributions weekly. Now, of course, distributions are never guaranteed, so we don't know exactly what those distributions will be, but that's their strategy. This fund came out January 6th of 2026. But here's the thing, the initial assets under management, $202.17 million as of January 13th. So within a matter of 6 days, this thing is really rocketed about $2 million. Now, the TDAC one, exactly the same, just using it under the S&P or the NASDAQ 100 instead of the S&P 500. So what they're doing is they're taking and using their very popular TSPY, adding some leverage to it, using swaps. So they're not really owning anything. They're using swaps. So they have cash in the side that they have the option, because it's in-house, that they can buy TSPY ETF, and their swap, that's what the swap is about. And they're trying to get with more covered calls of that 130% coverage. Now, what is that T-lift? I'll explain to you a little bit more what we're really talking about here. What it does is T-lift is a light leverage version of the TSPY. They deliver 130% of the daily performance with enhanced income potential. They're amplified the growth, 30% additional exposure to the underlying product. And then they're turned this thing into their weekly distributions now. So you're taking the underlying, the gray line, and you're saying this is the normal 100% exposure. This is what the ETF is doing. You see some ups and downs across the board. Then what they're trying to do is get that 30% leverage. Now, I will tell you the risk and reward of leverage. It's great when the fund is going up. You're increasing and amplifying by 30%. When you are having downturns, the reverse happens. You're dropping 30+%. So the 100% exposure is what we're talking about, is in that T-lift. Now, their partnership is with Tap Alpha and Turtle Capital. The strategic collaboration combining experience to deliver that T-lift series. So Tap Alpha knows how to use that zero DTE experience. They have it. They've been using it with their funds very successfully. Now, Turtle Capital is the bold ETF innovation. It's a light leverage ETF structure that's strategic to use in total return swaps and enhances the income distribution. So what they basically did is they partner up with someone who understands leverage, understands how to do these swaps and income distributions, working with one of their top-notch pieces, which is that zero DTE cover calls of the NASDAQ and on the S&P. So the fund structure and mechanics of it, the daily leverage ETF structure, the TSYX and the TDAX are designed to deliver that 130% daily performance of the underlying benchmarks. So they're using the leverage mechanism in those total return swaps, allowing the leverage to be exposed without direct equity holdings. That's a critical piece. So they're able to, the unique I find is they're able to adjust fairly quickly as the markets change and trend. And the daily covered call strategy uses that 0 day to expiration option, which generates that income. People are buying those calls, paying a premium for it, because you virtually know what is going to happen. You have very little short period of time to make a decision or make adjustments in the market. It works tremendously in overnight experiences. So in the fund flow operation, you can see is the underlying stock to the total return swaps is 100%. Now, those total return swaps, trying to get an increase in 130% exposure using zero DTE covered calls to pay you those weekly distributions. The weekly distribution is what the real big game changer here. Using that leverage to generate that weekly income versus the monthly that at once most funds pay, you're going to have an enhanced cash flow for more frequent periodic income payments, the improved reinvestment, so more opportunities to deploy your income to reinvest in the products, and the strategic flexibility. I put here on the screen the price change just with a little bit of knowledge, a little bit of information that we've had. You can look, and it actually shows both on the screen. This is why I like to put this up there. Look when the SYX, the new T2 lift, is in the brown, and the blue is our TSPY. So you can take a look at it. Now, this is a very, very, very short window. I'm talking probably less than about 3 days, 4 days of trading. You can see the 30% increase happen right off the bat. Look at the price of it. It's well over 1% growth, while the fund was about 0.5%. Now, when the price of the fund of the TSPY dropped, it dropped well below. It's down to 0.11% versus TSPY down 0.20%. So you can see that this has the 30% growth and the 30% drop off across the board. So it really comes into is how the underlying stock is going to perform to see if that 30% will work out. So let's take a look at the underlying or the fund itself, where it sits today, and then we'll give you some futuristic lookout. As this is a brand new fund, this is the S&P 500 version. You can see year to date, again, we're only maybe 7 trading days. I think we got some weekends in there, so we're actually a little less than that. But you're up 0.21%. That $2.17 million in assets. Their expense ratios are 0.98%. And like I said, January 7th is when this thing come out. So there's not a lot of data to use. That's why I held off in doing much with this. I was hoping to get a distribution put in there so we can see kind of what they're going to pay. But we started showing us this is to give people the idea of what's going on. Now let's take a look at the TDAX of the performance of this fund, and you can see they both came out same day, same amount of time. This one's down 0.79%. Okay, 2.88 million. So they're both growing about equal to each other. 0.98% expense ratio. So this one here shows the best of that. The equity doing good, that 30% growth, and that leverage of it also doing bad, of coming back down. So you can see the bouncing in the fund. Brand new, like I said, totally brand new. There's not enough information to really express how these things are doing or what they can do. All we can look at is the underlying shares of how the funds have actually produced. So let's take a look at it this way. The TDAX performance projection, with that leverage of that NASDAQ 100 with the 130% exposure, this is projecting a return of 19 to 20% with that 30% leverage. Now, how do we come up with that? Well, if you take a look at what TDAX is doing, TDAX is right now, the forecasting out is about 17.37%. The leverage effect would give you an extra 2 to 3%. And our calculations came out about 2.13% to give you that projection of 19 to 20%. That's where the positive part of the leverage is using. And you're going to be having your weekly distributions across the board. Now, when I take a look at the underlying funds, the performance of this one here, TDAX again, using it against QQQI and QDTE. So this is Round Hill, this is NEOS, and now this is TAP Alpha. So you got to look at the underlying side of it. And what's expressing to me is, look at the TDAQ already is well above the two big leaders of QQQI and QDTE. But look at the numbers. Look at the stock price. QDTE is down 12.07%. They've had a bad, pretty much a bad December across the board, while everyone else has held their own. And TQDQ, boy, these numbers are tough, aren't they? TDAQ is up almost 2 percentage points above QQQI. So if you can see that the fund is doing well in good times, bad times, when we take a look at it, TDAQ with that increase, that 30% leverage increase, that's why we're saying we're seeing about forecasting about a 17% total return off of 12 months. Now we're going to take a look at the S&P 500 version. So the TSPY is in blue, the SPYI is in brown, and the XDTE is in purple. And you can see that the T-SPY and the SPY-I both are really running neck and neck with each other. You see some growth back here in October. You see a little bumps ahead. It's like they do better. They don't have a capped top end. They do better on that side than the SPYI does. But at the end, they're both about the same, exact about 4% increase over the period, over the last 6 months. While XDTE, you can see, has been trailing well behind these guys. And they are now well over 13% below what SPY and TSPY are for price changes, because they're down 9% and everyone else is up 4. So a negative 9 plus a positive 4 is a total 13. So the leverage advantage, again, that we show you here with the both funds, that if the market gains 10, the fund should gain 13. Okay, and that's that leverage working together with it. Now, it magnifies your losses. If your losses are down 10, you're going to lose another 13. So the leverage is a good positive for upswings and bad for downswings, but you can't choose your ups and your downs. So you really have to be careful with your underlying stock. And this is how a lot of weeklies have been messed up, is that they use too much leverage trying to go forward. So the key risk factors of these funds is simple. The leverage risk. It modifies the gains and modifies the losses. The volatility drag. Choppy markets cause performance erosions. So the old buy high and sell low repeatedly is what they're trying to avoid. Unsuitable for long-term holdings. These are not something I would be holding on to. These are things that I would jump in and jump out of on a fairly consistent way. Now, the counterparty risk that relies on total return swaps, and swaps provider failures to impact the fund, and NAV erosion possible during stress. So what we're saying here is it's only relying on swaps. It's not relying on anything. It has no value other than the underlying asset, which is the ETF from Tap Alpha. So you're not adding anything for growth. You're working, everything is off of those pure swaps. And market timing, it requires active market timing. That's why these are all managed properly. And avoid periods of market eruption. And it's not a passive long-term investment. And I'll explain to you shortly why. So here's the strategic use of it. And now this is not financial advice. This is just pure understanding how markets work. The market, when you deploy during periods of the market fear or extreme fear, okay, the ideal entry point follows significant corrections. So I'm using the November-December 2025 sell-off. If you remember, in November, December, we had the big sell-off. It was the market adjustment, the fear of the market. And I believe this one was the AI bubble we were worrying about. The markets took a drop. This is when you want to buy into something with this, with that 30% leverage, because the leverage, once the market evaluates and starts to come back, the leverage is going to multiply your growth. So you want to be in it when we call it the market is fear and we're in downturn territories. So you want to wait for this. Is a little bit, I know this is going to sound like market timing, but when you know the market is turned down and when you start to see the recovery, this is when you want to jump in on these to retain that 30% growth in product. And then reinvestment discipline. Retain cash during bull markets. Deploy distributions during market corrections. And maximize that 30% additional exposure. So again, I show you in the last slide here is the normal investment that you're just constantly putting money back in. But if you would take in downward trends and hold your cash, when the market starts to change, you're going to amplify your return. So the investment ideas that we use, the ideal investor profile for these type of funds is a sophisticated investor with a higher risk tolerance. You're aware of the market approach. You have strategic thinking and you have a risk management focus. So what we're saying here is it's not for passive long-term investment. You're not going to buy these and put them in your portfolio and just sit and let them, let them linger. You're going to have to use these of times where you're going to be jumping in and jumping out. So the recommendations that's always been put out there, even this comes directly from Tap Alpha, and it uses as technical tools during market stress. You want to be buying in, you can buy into these. Deploy strategically. They're time reinvestments. Don't use as a core holding. Buy during the market and hold through the corrections. Ignoring risk management. So you don't want to ignore the risk management, okay? Because remember that leverage is going to work both ways. You want to hold through the corrections. Hold tight because that 30% is going to rebound you quicker, faster out of the market. And again, don't use this as a core holding. The core holdings to use would be the TSPY and the TDAX. So the management risk framework, entry time discipline. Buy during the fear. Don't buy, at the hype. Don't buy at the top. I always tell everybody you don't buy these things until you've gotten about 6 months under your belt. And that these are really designed to buying in the flexibility when we have market corrections. The distribution management, retain cash, and strategic reinvestment. Deploy your cash during corrections for that leverage impact. What's unique about this, that when they talked about it, was that they're not promoting this as the new greatest funds in the world. What they're using this as another tool in your toolbox, that when you get into a market that's starting to correct, okay, use these to amplify your growth. And this is why it's not for everybody. You need to understand what's going on to it. So the volatility trap and avoidance, choppy markets, daily rebalancing causes erosion of a range-bound conditions. So when you have sustained downturns, that's the leverage amplifies its losses. That's why we're telling you, you want to be out of these if you see the market start to drip or drop off. And the market awareness is strong trends, optimal environmental for the leverage exposure. You see the market starting to see some growth. You're starting to see some changes, and you're seeing it in the S&P 500, which is what you want to be watching. That's when you want to make your changes. Sideways actions consider reduce the exposure or switching to the alternatives. And what's the alternatives? Is going directly to the underlying stock, which is that TSPY. So I know this has a lot of information behind it. Your head's probably blowing off now, but tell me what you think about this. Are these funds that you really want to invest in, or are these going to be tools in your toolbox to work later on when the markets rebound, recover, and so on? Personally, I like that it's a monthly or a weekly payer versus a monthly. I'm cool with that. I like that part of it. But other than that, it's kind of one of these things that if we had this back in November when we're hitting the market downward trend, would be great to be getting that 30% growth. But overall, we're not trying to achieve a 30% growth just from these funds. We want to use it to help balance out the marketplace. Let me know your thoughts onto this. I'm really serious about how people think about these funds. Are they good, bad, ugly? I know I'm sitting off on them for at least 6 months to get some information on it, but let me know in a comment below.